From Tencent's 52 weeks low of around 190 Hong Kong dollars per share, it's currently up 80%, trading at 349 Hong Kong dollars. And the natural question is it finally time to buy Tencent too? So I'll try to break it down in this video. For those of the first timers here, for context, even after the monstrous rally of 80%, the last time Tencent had this valuation was around 5 years ago, on October of 2017. Essentially, the stock itself went on a merry-go-round and came back to square one. So for the purpose of this video, I wouldn't do a specific business breakdown per se, because I've already done one before. So if you're more interested in trying to understand and appreciate what Tencent does as a business, you should check out my video with this title, A Simple Presentation on Tencent Stock. So this video was uploaded back in August of 2022. 4 months have passed. I don't think the business has underwent a significant enough change to warrant another video. So I'll leave the link to that video in the description box down below as well. So in this video specifically, I would like to address some of the key risks and also key concerns around this investment opportunity, and also explore the possibility of whether Tencent deserves a space in your portfolio. So you know what doesn't need to be explored? Liking the smash button, of course. So just close your eyes and just smash onto the like button. So you'll never go wrong with that. Now, let's get some simple facts out of the way. Compared to 2017, Tencent in 2023 is a much stronger business on every single business metric. Their total revenue ballooned from 271 billion Hong Kong dollars to 639 billion based on the trailing 12-month figures. That's a 2.3x in 5 years and a CAGR of around 18.7%. So their gross profit doubled from 133 billion to 268 billion. Net income is near 3 times, from 80 billion to 200 billion. But just note that Tencent runs a pretty huge investment portfolio, so they have to usually write up or write down their investment gains from time to time, especially when the market is experiencing some sort of turmoil, which affects their bottom line numbers. So cash flow from operations grew from 106 billion to 161 billion, and that's a 50% bump in 5 years. So you would be thinking, hey, this must mean that the market is being irrational, right? Because it does seem like on any single business metric that we pick, Tencent is a buy based on past growth trends. So I would say probably yes and no. Yes, because it's true that if we were to judge based on the two set of figures that I've provided, comparing 2017 with 2022, it does seem like Tencent is a much better deal today, compared to 2017 of course. On the flip side, it's not really a good deal because we might fall into the trap of something called anchoring bias. So just because the stock traded at X dollar 5 years back and the fundamentals have vastly improved 5 years later and it's back at X dollars again, it doesn't make it a natural buy. So we'll seek to explore this contentious point in this video. So firstly, there might be 2 specific scenarios that might explain this phenomenon. Number 1, it is indeed undervalued now, so it's definitely a good buy. Number 2, it was overvalued 5 years ago, and the market is just waking up to reality, and essentially, the stock price just normalized downwards. So for the record, I think it's probably somewhere in between. So let's not forget that the market is always forward-looking. Everybody is trying to price in expectations. So let's assume that we currently don't have the benefit of hindsight. So we don't know exactly what transpired to Tencent as a business between 2018 to 2022. So if we were to put ourselves in the shoes of the investors back in 2017, we were dealt with this set of cards. So in the last decade, before 2017, Tencent grew revenue per share from 80 cents to $25.26. That's 31.5 times. Free cash flow per share grew from 24 cents to 7.88. That's 33 times. And this was the modern day China growth story. Furthermore, you are buying one of the best balance sheet out there in 2017 with an impeccable execution and track record. So you touch your heart and you ask yourself, would you not be willing to pay a premium for such a mystical creature that is able to execute so well thus far? If we were to look back, it was indeed true that the market was ascribing a premium for 2017 Tencent. So just take any commonly used valuation metric. Their PE ratio in 2017 was easily 40 to 50 times. EV to EBITDA was 30 to 40 times. Price to free cash flow was also in the high 30s. Today, using the same metric, PE is near the mid-teens, EV to EBITDA is near 20 times, and price to free cash flow is in the high 20s. Look at how far we've come. So this was also why I made the initial claim that we were probably somewhere in between for Tencent. It might be overvalued in 2017, if I can speculate. So 2017, Tencent was probably hyped up by enthusiastic investors as they had very high expectations for them to continue executing out into the decade. So Tencent in 2023 feels like the concubine that lost the attention of the emperor. So I think there are three key factors that I wish to explore that essentially squashed Tencent's valuation in the last 2 years or so. Firstly, investors had a rude awakening to Tencent's so-called growth story. So in the earlier part of the decade, they grew 30 to 50%, piece of cake. So this latest financial year, however, they even reported a negative year-on-year growth, with analyst estimates out into 2025 to only be in the low teens growth rate. By low teens, I mean around 11 to 12%. So when there is this huge compression in growth estimates and growth story, then naturally, valuations will reflect that. Secondly, if we were to observe the rate at which Tencent is able to invest and yield a return on the invested capital, the ROIC for Tencent was easily above 20% pre-2017. Now, at least in the last 5 odd years, it has managed to fall precipitously to around 15% based on the trailing 12-month figures. So it does seem like Tencent is slowly losing its magic to compound capital internally based on the different projects that they take and maybe investments that they invest in. So last but not least, thirdly, everyone suddenly woke up to the idea that China is suddenly uninvestable. Okay, I'm joking. I think sentiments do play a role in affecting valuations in the short term, but I find it ridiculous because in 2017, CCP was in power. In 2022, CCP is still in power with Chairman Xi still at the helm of every single China issue. Sure, you can argue that geopolitical tensions seems to have escalated up by a few notches. But at the end of the day, let's not forget that by investing, you're trying to be the owner of a business. A majority of Tencent's profits are being derived from China. With or without the United States, they are probably going to continue innovating and continue expanding their business and continue selling their services to the Chinese people. So it might be affected in the short term, but I think their business is still largely intact, despite their international exposure. So I think the key problem from this China piece was really this tech crackdown that started back in 2020. So gaming approval came to a screeching halt. So minors were completely restricted from gaming, and you have a whole host of other problems around algorithms, around data privacy, around data harvesting, etc. So this would inevitably drive the cost of business up because they have to maintain a lot more administrative details. So I think just to add in a side point here, there are also two critical factors that I'm closely monitoring now. Number one, Tencent now seems to be forced to give up many of these initial investments that they made in young tech companies like JD, Meituan, etc. So my perception is this. It's not that the CCP is trying to stop them from investing in the VC space. In fact, they would encourage them to pour in more capital to spur innovation, but more so to try to cut the linkages between these different subsidiaries that were investments to start off and essentially spur an anti-competition culture. Moving forward, I would presume that Tencent will continue to invest heavily in many areas, and most probably, if I can speculate, mostly aligned with the government agenda, from green tech to semicon. And if they're successful with picking the next unicorns of China out into the decade, they'll just be able to issue dividends to shareholders again. So this is my theory for now, which requires more time to confirm. So let's keep our eyes peeled. Secondly, ByteDance seem to be a force to be reckoned with from both Alibaba and Tencent's perspective. Time spent on both platforms are on the decline, with ByteDance essentially sucking away everything from all of them. But that said, I think it's too early to conclude that Alibaba and Tencent lost the battle. But I do see this as a potential threat in the medium term. So everything I said can be categorized in these three categories. Number one, do you believe Tencent, and by extension, China's growth story is dead? Number two, do you think the headwinds around Tencent will be short-term or long-term in nature? So by headwinds, I mean from ROIC to margins, to their investments, to their competition, to their government relationship. I know it's a mouthful to handle, but you get my point. And number three, did you smash the like button? New year, new sign-up rewards. So Weibo's new welcome deal for the start of 2023 has never been better. So you can get up to $150 trading vouchers if you fund and trade your Weibo account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade on a stock or ETF and one mutual fund, coupled with buying one option, and you'll get to enjoy a whopping 10.5% return on initial capital. So for those of you who are still considering sitting on the sidelines, I don't know what's holding you back. So when the markets are slowly selling down and S&P 500 just keep grinding downwards, I think it's a good opportunity to start dollar cost averaging into the markets. And you can even get an additional 150 US dollars to do so. So Webull prides itself on zero commission trading, and you can stop paying all the redundant commissions and use it to buy more shares. So recently, they've also allowed for a zero fee subscription and redemption of mutual funds on their platform. So don't let this opportunity slip away so easily. Link to sign up is in the description box down below. Thank you Webull for sponsoring this video. So I think more specifically, when things are looking bad, it tend to look worse in the short term. Of course, I'm not saying that it's easy to predict the future. If not, everyone would be a millionaire by now and investing should be easy. All I'm saying is this. If you buy a relatively strong business that has a strong enough competitive advantage and it doesn't trade at an expensive valuation, you'll probably do well in the long term, as long as you weren't too far in trying to estimate the value of the company. So with that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!